Hello everyone, welcome to another session on dollar INR. It has been a relatively quiet 2 weeks. All of us know it was the Christmas and New Year season. So trading volumes were thin and markets was relatively quiet both globally as well as on dollar INR. But today we saw the first bout of some good volatility. Okay, yesterday the markets are open but trading was quite thin. Today the markets was the second working day of this year and we saw some good amount of volatility. So I wanted to show you something very interesting. Okay, all of us remember this date, okay, which is the 19th of December. Okay, 19th December was that day when RBI had intervened very aggressively and we saw that rupee gained from 90.20.25 to 89.25, almost 1 rupee gain that we saw on that day. But now what has happened after the 19th of December? In 9 trading sessions we are back to 90.20.25, which is the same level from where we started. Okay, so in 9 trading sessions we have come back to the same level. So RBI intervened and now the market forces, the demand supply mechanics have got it to the same level again. Okay, so this is the onshore chart, the 9 AM to 3:30 PM chart. Let me show you the offshore chart as well. Okay, let me show you the offshore chart. Okay, this is the 24-hour offshore chart, a very clear uptrend. We have identified the 25-day SMA, EMA as well as the 50-day SMA. Okay, some technical signals, and we have identified that this 25-day SMA and EMA, these lines, okay, these two, the purple and the yellow line, these are good support indicators. And very similarly, we saw in the recent past the prices coming below it could not sustain. Now it has come above it. So both the 25-day SMA, EMA is a very good indicator of short-term support levels. So importers need to look out for these levels and do some hedging. Okay, otherwise it's a very clear-cut uptrend and it is very easy to read higher highs and higher lows. So dollar is on a strong uptrend. Okay, if you look at the entire year 2025, from Jan to December, from 1st Jan to 31st December, rupee has weakened by 4.9%. We started at around 85, 60, 650, 60 and it closed at 89.87. Okay, very close to 90. So it's around a 5, almost a 5% weakening in the rupee. Okay, now beyond the spot, the real action also happened in the forward premiums. Okay, all of us knew that RBI did a swap and it was the calendar year end. There was a decent amount of paying interest, importer hedging interest, paying interest in the short term, and we saw the forward premiums going higher. This is the 1 to 12 month forward premium in percentage terms, okay, for different dates. Okay, so if you look at the extreme right, this is the 1st of December, which is this particular line, this yellow line. Okay, this is the time when things were very normal. Okay, even if you look at 8th December, 8th December is this line. This is the time when the premium started going higher. And if you look at the period after the swap happened on 15th, 16th December, and after the 15th, 16th December, if you look at these two lines, okay, these 3-4 lines, these are all the lines between 15 to around 29th December when the premiums shot higher. Okay, the forward premiums had gone very high. In a couple of days the premiums were as high as about 49 to 50 paisa per month. Okay, for 1 and 2 months the premiums were really high. But now, since the year end pressures are over, the swap effect is over, now we have seen the premiums coming back. So if you look at the 1st Jan and 2nd Jan, 1st Jan is this red line and the 2nd Jan is this green line. Okay, now see, it has come back to the same levels of 1st of December. Okay, so the premiums that had gone higher, forward premiums in dollar INR that had gone higher, has come back to the same levels which was there prior to the swap and prior to the month end impact. Now premiums are very important to very important variable in the market because that helps in taking a lot of decisions, and I came out with a video a week back when the premiums were high, how to capitalize on high premiums, and you can move your working capital funding, export funding from packing credit in foreign currency to packing credit in INR, and then take a hedge to capitalize on the high forward premiums, and that high forward premiums help you in reducing your hedge cost. You should certainly look at that video. I shared that video about a week back. Those are very good ideas and strategies on capitalizing on market inefficiency. Okay, this premium rise was very clear that it is a short term phenomena. It usually happens in December, and it will again happen in March when the year shifts from March to April, the financial year shifts. This phenomena will happen again. So all of you who would have missed, I am sure a lot of you have capitalized after looking at my video and how I shared that intelligence. A lot of you might have capitalized on it. For those of you who have missed this, please be aware that this will happen again sometime around the end of March, when the financial year shifts from 1 year, from 25-26 to 26-27. So they will see a premium shooting higher again in that short 3, 4, 4, 5 days period. Okay, so what we have seen here is a clear uptrend in the dollar INR, what I showed you before, and then this premium chart, and then let me come back to the dollar INR again. So here, what is the advice or what is the risk hedging solution for all exporters and importers? Since it's a very clear cut uptrend, rupee weakening has been more, forward premiums has been less. So exporters can have lower hedge ratios, but remember the risk of having lower hedge ratios, which means you have higher unhedged positions, you will be exposed to the volatility of the market. But since rupee is weakening consistently, that is going in your favor. Okay, so importers are a more worried lot because rupee weakness is far more than the hedge cost. So importers should look to increase their hedge ratios and specifically look at these moving average support levels to increase your hedge ratios. Okay, another important thing what has happened in the last 2-3 weeks because of quiet trading globally and also in India due to Christmas and New Year holidays is that the dollar INR volatility had come down, and since volatility had come down, the option premiums have become cheaper. Okay, I'll just give you an example. If you want to take a 1 month option, an ATM option where your strike price is equal to the forward rate, again ATM option, strike price equal to the forward rate, 1 month, earlier it was costing anywhere around 45 to 47 paisa per dollar for 1 month. Now it costs only 39 to 40 paisa per dollar. So there is a good 5 to 7 paisa per dollar reduction in the option premium for 1 month. Similarly, if you do for a 2 month option, vanilla option for 2 months, again same ATM option where you are looking at strike price is equal to the forward rate. Sometime back these premiums for 2 months was around 65 to 67 paisa per dollar, but today because of lower volatility it is around 55 to 57 paisa per dollar. Okay, so that is a decent 10 paisa reduction, and in this hugely volatile times, paying an option premium of 40 paisa for 1 month and about 55-56 paisa for 2 months, that is a great deal. You are looking to hedge at a highly reduced option premium cost. Okay, so vanilla options are certainly a must for all exporters and importers, and for importers specifically if you want to do forwards, look at these technical indicators to market time your hedges, and exporters can keep lower hedge ratios since rupee is continuously weakening. Okay, so that is it from my side. Have a great weekend ahead.